Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as I go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, sectors, looking for investment opportunities and sharing those opportunities with everybody in the community. We do have a special coupon code that is active. You get $25 off, which ends up being $25 for the first month only on the monthly membership. And it's a $500 charge for the yearly membership if you'd like to join the community and gain exposure to my strategies, my approaches to the market, and the companies that I like. Ian Castle, the difference between trading and investing. Investing, your intention with every purchase is to hold. Trading, your intention with every purchase is to sell. And a lot of people will ask me, well, what is your price projection? When are we going to sell these things? That's the trading mindset. I'm in the investing mindset. Your intention with every purchase is to hold until I see otherwise, until something occurs. Now we are really early in the commodities bull market still. We had a nice big surge in 2020, 2021, up to the peak of 2022 in a lot of different commodities. Then we've consolidated and gone sideways in a lot of them from 22 to even maybe 2025, like April of 2025. A lot of them have done a double bottom, or they're sitting on top of their bottoming pattern, depending on what you're looking at. Like copper is sitting on top, gold and silver are sitting on top of their bottoming patterns. Some of the oil companies and energy service companies are putting in their double bottoms. So we're really, really early in the bull market. So when someone asks, I mean, it's kind of like asking somebody in 1982. Let's go back. I'm just going to kind of give you an idea. Okay, so here's the SPX. I'm going to put it on log, and we're going to back out. Let me put it on a line chart so it's a little bit easier to see. All right, so we've got this big long chart in the in this cycle, right? It's like back in the early 80s here, like in this area, all through here. You're like, well, I purchased it here. Should I sell it? When should I sell it? And that's like 1978, right? And I'm like, well, I don't know, maybe sell it out in 1999. Like, I mean, the commodity bull market that I think is coming is going to be so long and so sustained that I can't tell you when to even like when this will be done. So what happened is we went into this big bull market for stocks because we peaked in interest rates and then interest rates started to pull back. So it was right here where you want to load up in the stock game and then hold it all the way down in that declining interest rate environment, which this was going all the way up. And yes, we did get a pause in that bull market, but we still had the decline of interest rates. We're like basically at the beginning of this unwinding. So if I were to draw a downtrend line on this, and then we've broken that downtrend line, like we just started this upward breakout here. And if I were to, draw it back here, and if we look backwards, we increased interest rates from 44 all the way up to 1981. It's almost a 40-year period, little less than 40 years in an increasing interest rate environment from here to here. So if someone says, they're all asking, like, well, when's a good time to sell? And you're in like the 40s. You're like, I don't know, 1980? Like 40 years from now? You're like, well, I'll be dead by then. It's like, well, that's a lifetime hold. I don't like, we're so early in this move. Like, we just started to peak out, and it's like, I don't know yet. We're so early. Like we are very, very early. We're early in the commodity to stock ratio. We're early in interest rates breaking out. Um, and I mean, we'll see. We'll see what happens. But I'm just trying to give you guys like an idea. You know, when I'm buying this, I have every intention is to hold it. Other people like they're looking to sell this thing as quickly as possible. It's like they want to try to get short term taxes. Like, and I'm sitting here like I don't want to sell anything. I just want to hold on. Here's another thing. Here's a XAG USD, and then you look at interest rates. That's like you purchase interest rates when interest rates just broke out. So you're buying silver down here on that. Then you wrote it from this is all the way back in 1933 and 1941. So 41. This is a 40-year hold in silver where you had in physical silver, right? Let's do a price. So from here to here, it went up 100x. 100. It's 9,970% is what it went up. It went up that amount in physical silver. Now, we just broke out of interest rates and we're about to break out of this big cup and handle, like the largest one. And people are going to be like, well, what's the price target? When should we sell? And I'm like, Jesus, guys, like, I mean, this is like equivalent breakout that we've got going on here. I mean, maybe it's equivalent to like 1972. Maybe it goes for another 8 years or 10 years or something, and maybe it'll be three, four, $500, $1,000 an ounce. I don't know. I mean, it really depends. And if interest rates are just breaking out, maybe this lasts a lot longer than what I think. Maybe we have a long way to go. So it's hard to know at such an early standpoint. And something like let's go back here and look at Nvidia. So last cycle, the cycle bottom for Nvidia is, let me get these out of here real quick. So the cycle bottom for Nvidia was 2009. So we went up in this area, but this was really the bottom of the cycle was all through here. And if someone's like, well, where would I sell in Nvidia? And it's at 31 cents, call it split adjusted. And we're at $188. And I'm going to be like, well, we're going to do, uh, let's say it's a 600 bagger here. We're going to do a 600 bagger. You'd be like, shut up. It's not going to 600 bag. But I mean, that's kind of what it did. So, I mean, this here is like where we're located in commodities. Like we're just starting to break out of these big patterns and perhaps create new highs like copper and other ones. And this is what's coming. And even if I told you what I think could occur, no one would believe me anyway. They'd be like, yeah, right. So could copper companies go up 40x, 50x, 60x? Yeah. Could silver do it? Yes. I mean, that's how early we're at. Breaking, President Trump announces 50-year mortgages in the United States. I'm getting all these, like, most of my feed is on this 50-year mortgage thing. So someone looks in and says on a $400,000 mortgage at 7% interest rates, a 30-year mortgage is 558,000 in lifetime interest. A 50-year mortgage is 1.116 million in lifetime interest. With a 50-year mortgage, you pay double the amount of interest compared to a 30-year mortgage. It says we are in a crisis. I mean, okay, so you pay that interest, but what's the value that you pay back in that mortgage with high inflation rates? So, I mean, if you look backwards, 50 years ago was what? 1985? No, it was 1975? Yeah, it's 1975, isn't it? Like that's a long time ago. It is. It's like 1975. Can you imagine buying a house with a 50-year mortgage in 1975? Do you know how much our dollar has declined since 1975? You're not paying back 1.16 million in purchasing power. It is far less than that. Far, far, far less. So most people, what I'll say is they have no idea what they're doing when they talk about this. Because 1.16 million, I mean, that's probably what a car is going to cost 50 years from now. Think of it that way. Oh, you paid 1.116 million in lifetime interest. It's like, well, that's what a Chevrolet car costs now. Is 1.116 million 50 years from now. That's what the purchasing power will be reduced to. So I don't know if that's a good deal. I mean, if you get a low interest rate, like if you got like a 3% interest rate and you did a 50-year mortgage, oh my God, that would be such a good deal. And I'm being 100% serious. A lot of people say mortgage and debt is bad. It's like it is. Yeah, I don't think debt's good. But can you imagine paying back a 50-year mortgage at like 3 or 4%, and in year 50, your mortgage is less than a Chipotle meal? Like, you're like, yeah, I'm still paying off my mortgage, and yeah, Chipotle costs more than my mortgage now. Says I really like Latin America. Latin America literally went out at the highs of the week to new multi-year highs. More evidence of expansion in upside participation and sector rotation all at the same time. That's ILF. Let's look at ILF because these guys like to zoom in on the charts. So this is iShares Latin America. It's just one big squeeze fest going on here for Latin America. It's a falling wedge that basically just broke out and it's ripping. It looks fantastic. But you know, all of them look pretty good. I mean, I could pull up. Here's an Africa ETF. So VanEck Africa Index ETF. Well, that's breaking out too. Look at that thing. That's the snake, the cobra head. Usually you get a big breakout when you break out of these like bases here. I think maybe I did that on log, but you break out and then you get a consolidation and then it will go. This is the cobra snake. But yeah, they're all doing it. So it doesn't, and more than likely what's going to happen is the dollar's going to drop in value against these currencies with time. I think this is people front running all of it. Charlie Munger's core principles. Let's look at this. So, Charlie Munger, an eminent investor in his own right, expressed several Buffett-esque investment principles in a speech of which John Templeton sent me a summary. Here they are, slightly edited. So, specialization in the business world often produces very good business economics. Advantages of scale are important. When Jack Welch says he's either going to be number one or number two in a business or out, he's not crazy, just tough. Too many incompetent CEOs do not understand this, but bigger is not better if it creates bureaucracy, e.g. the federal government or AT&T. Technology can either help you or kill you. The difference is whether the customer gets all the savings or if some of the savings go to the shareholders. Investors should figure out where they have an edge and stay there. Stay in your circle of competence. Remember that John Train question. How do you beat Bobby Fischer? The reply is get him to play you in any game except chess. Winners bet big when they have the odds, otherwise, never. Those who make a few well-calculated bets have a much greater chance. Very few investors or investment funds operate this way. So load up on a good idea. It is hard to find a good business at a great discount. A significant discount means more upside and a greater margin of safety compared to the downside. Buy shares of a good business at a significant discount to what a private buyer would pay. Buy quality businesses even if you have to pay up. Warren Buffett claims this is the most important thing he ever learned from Charlie Munger. A low turnover reduces taxes and increases your return. Two investors earn the same compound annual return of 15% for 30 years. If the first pays a 35% tax at the end of the 30 years, and the second pays a 35% tax each year, the first investor will have over 2.5 times as much money as the second. So watch how much you are paying and how frequent you are paying taxes, is what he would say. And I've incorporated a lot of these not knowing it. I don't like paying taxes, so I try to hold as long as I can, which is, I mean, I've been going pretty good since 2020. And I agree. I think buying quality businesses, even if you have to pay up a little bit, is a much better approach than buying a crappy business at a cheaper price. So I agree with a lot of this. Yes. Against all odds, says ExxonMobil is a nose hair away from triggering a fresh buy signal on the long-term momentum indicator. The last time this happened, question mark, was back in 2020, 2021. We had a big bull run of 100% in ExxonMobil, which doesn't move very much. The companies that I'm interested in, some of them did over a 20 bagger or even a 30 bagger during that same time frame from 2020 till today. So that buy signal looks like it's about to hit here any second for ExxonMobil, and that's a leading indicator for the whole sector of the oil and gas space. Uh, I think we've got a lot of good opportunities out there in this sector, and I've already loaded up in them. I know some people say, well, how does that help me? How does that help me, Andy? If you've already loaded up, well, I mean, I don't know. I told everybody what I'm doing on the website. They loaded up when I loaded up. We're already positioned in a lot of the oil companies and energy service companies. Um, so I don't share that information on this YouTube. I do share that with everybody in the community on the website. And we loaded up in April and May. We bought other stuff, and I mean, I'm not saying I got it perfect. So I'm not stating that I perfectly nailed the bottom of April, but I bought all around it. I bought some in it, cost averaged in some more, and now, those are up quite a bit off those bottoms. And then now we're going to start to gain momentum. And then people are going to get really interested in it because the price gets moving. And it seems like people are only interested when price moves. And you gotta break that. You gotta get interested when patterns are looking good and when things are down. You gotta just beat the price chasing out of you and chase value and price. Scrap my call for $60 silver. We're headed to 100 to 200 in the next couple of quarters, says Michael Oliver. Mark this chart, you'll want to remember it. And he thinks we're going to a couple $100 perhaps, $100 to $200. Says Mike Oliver, and that's your cup and handle. Now we're coming in a cycle. It deals with interest rates. When interest rates go up, they're selling bonds, and if interest rates get to a certain level, they'll be selling stocks. So if they simultaneously sell stocks and bonds at the same time, money looks for a new home, aka silver and gold and platinum and palladium and commodities. Now, what happens if they do QE, which is a high probability, and they try to hold down interest rates below 5%, which could be a possibility? Then some people will say, oh, well, then the stock market will keep going up. It's like, yes, but I think commodities are going to rip if they do that. That's what I think could occur. And that's exactly what this chart is suggesting. So, XLE Energy, it says the refiners are leading the way higher in the energy sector, making new 52-week highs relative to the S&P 500. Oil services are making new multi-month highs too, which I'm very interested in because they're cheap. These are the wildest and most defensive stocks in the energy sector. So XLE versus SPY, you can see the RSI is going up. You can see the lows are coming up in the relative strength indicator. We're starting to potentially break some of these highs here very soon, and then work our way on up. in this ratio. You can also see that other things are doing it. It's not just XLE, crack divided by SPY, ripping higher, 52-week high. We've got oil services OIH ETF putting in a bottom and breaking out against the SPY and making multi-month highs above resistance, which is a breakout, which is very good. And see, this isn't at a bottom. Your bottom was down here. And that's in the ratio. The ultimate bottom was here in terms of nominal prices in dollars. It was all in here. But we've come on up. We're starting to outperform, and it's going to start to gain momentum. People are going to start taking notice, and then the FOMO is going to come in. All the FOMO momentum guys, they're all going to come rushing in, and then we're going to be talking about why oil's a good buy on Twitter, and I'm going to be like, nope, I'm not buying it. I'm going somewhere else. And that's what happens. People just, it's all sentiment. They just chase price. They're a bunch of squirrels running around looking for a nut. That's all it is. Gold versus oil, historic extreme, says Steve. He says, aside from the anomalous negative oil prices during the COVID crash, an ounce of gold has never been able to purchase more oil. Never. In other words, oil is cheap when priced in gold. I'm bullish on both, but one is likely to outperform the other over the next 5+ years. Cough, cough, energy is what I think he's alluding to. Yes, this is a great time to be looking at energy. And this is exactly the stuff that I look at, are these types of ratios. So yes, Steve is right. Elliott Wave International margin debt just hit another record. After pushing past 1 trillion, it climbed to 1.13 trillion in September, up 20.8% from its 2021 peak. This conventional measure of margin debt is at scary heights, but it pales in comparison to new forms of debt that financial engineers continue to conjure up. Margin calling. So you can see these big declines in the S&P 500. And they happen when margin debt is also declining, where everybody's got to sell because they've got margin calls. So decline, 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 and look at where we're at today. Big vertical jump in margin debt, and that could roll over where people get liquidated. And then they get margin calls. That's the liquidation. So is that going to come? I don't know. It sure looks like it's possible over the next, whenever it occurs. Tavi says, none of us own enough hard assets. Fed Williams, Fed may soon need to expand balance sheet for liquidity needs. Ah, the money printing is coming again, isn't it? Well, let's print some money up, I guess. I mean, now talking about money printing, here we go. So breaking, global broad money supply surged 6.7% year over year in September, reaching a record of 142 trillion. This measure covers 169 economies, representing 99% of global GDP. Year to date, money supply has jumped over 9%, driven by China and the United States. Since 2000, global money supply has risen 446%, or 116 trillion bucks, a compounded annual growth rate of 7%. China now makes up the largest proportion at 47 trillion, or 33% of global liquidity. The European Union follows at 22.3 trillion, or 16%, and the US at 22.2 trillion, or 16%. Money supply is going through the roof. Maybe that's why we're seeing gold rip and silver rip, and all these different commodities are going to start ripping. When they print money and interest rates go up, that's when commodities do their accounting for the money supply. It's coming. That's the oil services one. We saw that with the trio up above. And that's where I'm going to end it because we did that one last time. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials, the coupon code over there. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.